Good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday. It's the 11th of February 2022. And today we want to dig deeper into a topic which I think could be of interest for many of you. At first glance, the topic, the headline of the webinar, how flipping coins can bring you an edge in trading. Today's topic might seem a little suspicious, or something could cause some irritation, because flipping coins, I mean, at first glance, okay, there's a 50-50 chance, and then how could, if you're looking at flipping coins, how could this somehow give you an edge in your trading? In fact, it's yes, I understand what you might think right here, but flipping coins, we want to look at this from another perspective. So put this in another context here, in fact. And flipping coins here, so heads or tails, respectively 1 or 0. This is bringing us here then to the overall idea behind this Monte Carlo simulations, respectively, especially Bernoulli distributions in this context, or Bernoulli distributed Monte Carlo simulations. What this is, this will be the topic of today's webinar, and you will see that with these Monte Carlo simulations and these, to some extent, flipping coin idea, you can really gain an edge in your trading, especially from a mental perspective, gain mental stability, but also check out how your strategy performs under different market conditions or in different market environments. And so that will be the topic for today. We have plenty to cover. If you watch the recording now on YouTube, don't forget to subscribe to the YouTube channel. Don't forget to set a reminder so that you don't miss any of the videos which we're producing for you, not just me, but also my colleagues Paul and Marcus with this daily morning show in this case. And so if you have any questions, please leave a comment below. I'd be more than happy to answer them, especially around this topic, because this is one of my favorite topics, in fact, and one which not many cover, I think, but which could really make a difference in your trading. So let me share my screen, and let me also just check out the chat box. Yes, so hello Jens, hello. So let me also write hello traders. So this is the chat box where all of you who are here watching this now live, attend the event live, can ask you questions. And so I already introduced here the topic of today's webinar, how flipping coins can bring you an edge in trading Monte Carlo simulations. And this is exactly what we want to dig deeper into. Before we start, let me first introduce Admirals here as the broker who makes all these webinars possible. And in this context, I mean, I could imagine that many of you registered already via the website and know plenty of information, have already plenty of information available around Admirals, a broker which is in this industry, FX and CFD especially, for over 20 years now, global presence, fully regulated, licensed by the SISEC, ASIC, FCA in the UK. New regulatory body which is overseeing the business from Admirals is in Jordan, for example. A very competitive spread. So my location where I'm located, this is Berlin, Germany. So also here in Berlin, there's an office. And when we talk about the CFD trading, especially, and talk about Admirals, and we usually refer to Admirals as the DAX expert because of its very competitive offering when it comes to DAX trading. But this is not just DAX trading exclusively, but also FX trading, cryptocurrencies, physical stocks. So long thing short, it's definitely worth. If you watch now the recording, you have never visited the website, check out admirals.com for further information on Admirals. One broker, so I already mentioned this, global presence with several regulatory bodies overseeing the business. But more interesting, probably, this is the latest news in this case. So right now, from now on, you're capable of trading, in case of physical stocks, stocks at a fraction of the price. So, which means, like, probably you have ever wondered, is it possible to trade 0.2 Tesla or something? Because Tesla, one stock, one share, costs you right now, I think, 900 USD or something. So 900 USD for one share, it's quite a lot. And so now the question might arise that you want to start a little smaller. Or you say, well, I want to save, let's say, 100 euros a month, but I want to invest in Tesla. Let's take Tesla as a perfect example out here, because you say, well, there's a great growth outlook. I really could imagine the electric vehicle industry to take off, probably gain traction over the next 4 or 5 years. And I want to already start to invest now. I want to do this on a monthly scale. But the thing is that 900 USD per month is quite much. And you want to probably start with 100 euros. So it's very difficult to get such an offering. Case of Admirals, one of the major brokerages around the globe. Now it's possible to trade fractional shares. So check out the new offering here. In this case, it might then mean that you're buying, let's say, 0.1 Tesla share each month. And after 10 months, you have one Tesla share in this case. So very great offering. That's also true when it comes to dividend payments. We will do an extra webinar on this, why this is special. It will be at the beginning of March, but already that you know, this is available now. If you ever wondered if it will be available and what to do with this, now it's your time. And with Admirals, in this case, in the physical stock environment, you have a great chance now to participate in this fractional shares business then. So now let's have a look at today's agenda, and let's have a look here at what today will be covered. Since Germany is in the EU, then it's a CySec regulated in this case. So I see. Well, who's the question? Who is asking the question? It's Arturo. Okay, Arturo. Yes. So Jens is Admiral in Germany under Cyprus or UK regulation. So in Germany, it's EU, and that's why it's CySec regulation. CySec regulated. In the case of the UK, due to the Brexit, there was this step. Once it was taken, I think 2 years ago or something. It was the easiest way to make sure that there's no problems with those trading under the FCA regulated entity and those trading with the CySec regulated entity. Even here in Germany, it's possible to open an account within UK broker, respectively, a UK regulated broker. So in fact, you can really choose which regulatory body you want to have. Let's say you want to have Jordan, then there's certain reasons why this could be of interest for you, and everything around this is covered on the website. Case of the UK, for example, if I'm not mistaken, I think it's a little difficult as a retail client to trade crypto. But in case of CySec, it's possible, even though there's a lower leverage being offered under the CySec regulated entity, but still you're capable of trading these, I think. So there's some differences, but everything around this is covered on the website for sure. If you have questions that beyond that, what I just mentioned already, then check out the chance here to send an email to the service department and ask all your questions there. They are more than happy to answer them. Okay, so let's have a look here at today's agenda. So first of all, we'll give an introduction. So we won't give an introduction to coins, but we will give an introduction to Monte Carlo simulations, especially in this context. And so this will then answer the question, what are simulations, respectively, especially Monte Carlo simulations? Why are they so important for your trading? How to use them in your trading? How to really probably gain an edge, long-term edge here in this context? I want to give you then a real example. So you probably follow these webinars for quite a while now, and probably have seen also some webinars with me. And I think we started, I'm not sure, but I think December or already in November, we had a webinar on the DAX, for example, a breakout strategy. I presented here some background information. We also covered strategies in FX, for example, Euro JPY. You probably remember that. We also had a strategy on the S&P 500 here, open range breakout system. And we want to use this, by the way, the S&P 500 strategy, and use it, and then show you in a real world example here how to gain an edge here, or respectively gain something of value for your trading out of this webinar. And so let's start here first of all around the topic introduction. So first of all, in case of the position size, we have a very important question to answer, in fact. So let's assume you have a trading strategy, which you can, to some extent, already bring. You can somehow compare it to flipping a coin, because there's heads and tails. Let's assume heads is I have a winning trade, and tails is I have a losing trade. So somehow you can already compare it. And then you probably might wonder, okay, what's the right position size here? So what can I do with this? I mean, the thing is, I might have now an edge. I somehow observed behavior which is repeating over and over and over again. So it seems somehow to make sense to backtest this pattern I just recognized. So then let's say you write a code. Let's make things a little more quantitative here in this context. So it's not just that you write it down by hand, but you write down a code. You say, okay, there's a range forming, that we break out of this range, and after that there's a certain amount of pips, point, whatever, that the market moves in direction of the breakout, more often than it does not. And then you say, okay, now I find out that this really is an edge, that I have an edge here, and that I'm making money, even after commissions and everything. Great. So now you have this strategy, but still you don't really know what's the right position size now to capitalize on this edge you just found in the market, this pattern you realized. And so in this context, then we are confronted here with questions around not just what's the right position size, but we have to make sure that now the capital growth here in our equity is given, so that we are getting, let's call it that we get a big bang for our buck. So we make enough for all the work we put in and all the time we put in. But still, we also have to make sure that we are not risking too much to have too big drawdowns, so that we are getting mentally unstable in this context, especially respectively wiping out our account. So you have to find a balance here between these two. And so obviously, as you can see, if you have an edge, that's the first step, great starting point, but still the right position size then also corresponds strongly here with your personal risk appetite. So it could be that some mathematical formulas, Kelly criterion, for example, comes right to my mind. So you probably find out and say, okay, I have an edge, great edge, because it's saying, well, risk based on Kelly 3% per trade. The only problem is, let's assume you have a 10,000 euro account and you're risking 3% on each trade. From a quantitative standpoint, that might make sense. From a mathematical standpoint, that might make sense. But risking 300 euros per trade is not necessarily the size everyone feels comfortable with taking. So probably you might say, well, max 100 euros. And based on that, then you have to reduce the position size, or at least find ways how to, let's say, gain more confidence in trading a bigger size if the optimal position size is 3%, which is already quite big in this case. So now in this context, then so-called Monte Carlo simulations come into play. So what I want to do now is I want to introduce this concept here around Monte Carlo simulations. First of all, I want to give you an idea on what are these. So probably some of you have already heard about Monte Carlo simulations. Probably some have already played with them in Excel, for example. At the end of the webinar, I will also give you a website where you can, completely for free, play around a little with your input parameters from your trading strategy. Problem with this is it's a German website. It's my website, so I know you can be sure that this is a fine website. So no worries. There's no one I'm asking you for any details or something like that. The website was initially built when I wrote my second book. It's a German book, so most of you watching this right now also don't really know what to do out of this. So it's not promoting myself or my book or something, but it's just to give you a starting point to use the knowledge from here, from this webinar around Monte Carlo simulations, and without having to have some deep understanding of Excel, how to build these in Excel, and everything. We can also do certainly one, or rather sooner or later, a webinar around this topic. Probably there's some coding people here also watching this, and could probably play around a little with for example, Python in this case. But in case of the website, the idea why this website came into existence was when I wrote my second book, I was asked from a big book publisher over here in Germany if I want to write something, and it was on building profitable trading strategies in every market. And I was then wondering, will people really stay connected with the presented input? Because I mean, it's a very it's a niche product, let's say, and it's something which is sometimes very abstract. So if you read or hear something about risk and money management, everyone is saying, well, risk money management is so important when it comes to trading. There's no question about that, but it's still, after some time, getting somehow boring, or sometimes so abstract that you just get completely lost and probably lose the overall motivation to stay within this whole content. So I thought about how to overcome this. I really tried to give the reader here for the book then a learning experience, something they can read, they can understand, and then they can use it right from this moment on in the real world. And then Monte Carlo simulations here came into my mind, and this is then here why this website is there and how to use this in this context. But let's come back to MSCs here first, and then switch over to the website respectively. Let me introduce this concept to you. So MCSs, so Monte Carlo simulations, are a broad class of computational algorithms that rely on repeated random sampling to obtain numerical results. So this is the definition you can find on Wikipedia, for example. So very dry, let's say. In our case, so this is what we are interested in as traders. In our case, we want to specifically use so-called Bernoulli distributed MCs, also Monte Carlo simulations, or simply put, we ask a yes or no question. So is our trade a winner or not? So first of all, to get an idea on what these simulations are, let's assume you have a trading strategy and you have a hit rate, let's say of 45% or so. So then 45%, or let's say 50%, that means that in 5 out of 10 trades on average, you're on the right side. But it doesn't tell you when the winners will occur and when there will be a losing trade. So it could be that the first 5 winning trades are winners. So 1, 1, 1, 1, 1, if 1 is a winning trade, and then 0, 0, 0, 0, 0, and then you have a losing trade. So it could be 1, 0, 1, 0, 1, 0, 1, 0. And so there's different ways. So how to get winning and losing trades. Sometimes it's 5 losers in a row, sometimes 10 losers in a row. That happens mathematically. This is completely normal, but it's definitely something which you want to look at, and then look at different, let's say, distributions of 1 and 0, so winning and losing trades in this case. And this is exactly what we get when we look at Monte Carlo simulation. So you can easily get very, very complex here and very deep into the matter of statistics and everything. But in our case, we really want to use a so-called concept, which is called Bernoulli distribution, and which is just saying, in this case, it's asking a yes or no question. Is the winner, is the trade winner? It's a 1, or is the trade a loser? It's a 0. And then we have different ways to show this. So 1, 0, or 1, 1, 0, 0, 0, 1, and so on and so forth. So in our case, what we only want to say here is that the winning trade in our case will get a 1, and the losing trade gets a 0. And then if we have a so-called historical hit rate and a payoff ratio, so the payoff ratio is the average winning trade in relation to the average losing trade. So let's say you have a payoff ratio of 2 to 1. That means your average winning trade is twice as big as your average losing trade. You have everything you need to build such a Bernoulli distributed Monte Carlo simulation, in fact. So you can play with this then. And probably this is already getting getting a little too dry. And that's why I want to show you this screenshot from the website I just mentioned. So you can see there's several graphs. There's an overlay. And so in this case, what you really want to see is you want to somehow flip a coin based on different hit rates. So in case of heads and tail, you have a 50-50 chance that heads or tail wins. In our case, flipping the coin sometimes is connected with heads 40%, tail 60%, and so on and so forth. And this is now where the cycle closes, in fact, and where you get an idea on what we're talking about when flipping coins comes into play here. So for better illustration purposes here, imagine MCS, so Monte Carlo simulations, distributed via Bernoulli. So Bernoulli distributed Monte Carlo simulations. Just imagine as flipping a coin, in fact, generating different series of pitched and tosses and thus different equity curves. And in case of our trading strategy, what we get is that we get different equity curves based on different arrays of winning and losing trades. Already what I just explained earlier. And what we achieve with this, and I mean to say, okay, well, nice. I play around a little with different hit rates or different winning and losing trades. Great. So it's not really different hit rates in this case. But what can I gain out of this? So why is this what does it make sense for my trading? It gives us a chance to really stress test our strategy based on still historical input parameters. So this is very important. So you really look at a strategy at a certain point, and it might probably say, okay, I have 100 trades now. My hit rate in my trading is 60%, while after 200 trades, this hit rate might drop to 50%. That will sometimes happen for sure. And you might probably wonder, okay, what can I do after or about this? Or is this a bad sign? Well, it certainly will result in the equity curves to show a different way, in this case of winners and losers, and thus the simulated curves here will look different. But, and this is also something I'd like to put here or give as an idea. It's a starting point. So it's, for example, it's a static model. It just doesn't cover the overall learning curve you will naturally face when you trade the market. So if I have 100 trades, and let's come back to 50 hit rate of 50%, it's more likely that after 200 trades with more learning experience, more trading, I gain the overall experience, then I learn to stabilize the hit rate around 50 respectively. If it drops, then it's likely if I play here or if I work on the right parameters and letting my winning trades run, cutting my losing trades short, that the overall profitability, if I work on the right points in my strategy, right parameters here, that it will increase, and that even if my hit rate might drop to, let's say, 48%, it's caused by me letting winning trades run longer and cutting losing trades short, thus increasing here the chances that here the rising equity curve, even though it's a simulated environment, will continue to rise. So, but coming back to the stress test, and you're really focusing on getting drawdowns or smoothen the equity curve. That's probably a better way to put it. So what we want to do here is, and this is where Monte Carlo simulations are very interesting, we want to simulate different market environments. So at first glance, it looks like, okay, you have a hit rate, let's say, of 45 or 50%. Great. But this is like different market conditions. What do you mean? I mean, what we assume is that the hit rate, purely theoretical speaking, that the hit rate stays stable, let's say 50%, but that different market conditions can be seen in, let's say, longer losing streaks, for example. Let's say you have a trend or breakout strategy, and then you find yourself in a range-bound environment, for example. So then you have a series of zeros here, which are affecting the overall profitability here, and thus the overall profitability of your, or respectively the overall look of your capital curve in this case. But different market conditions are still here in this case can be seen in zeros, and in favorable market conditions, more ones, which means nothing more than more winning trades in favorable market conditions, more losing trades in unfavorable market conditions. And this is exactly what we try to get to see here with Monte Carlo simulations and different equity graphs, which we display here. So now let's work with a real example. So probably I'm already losing some attendees here because you say, well, okay, great. I can't really imagine what he's talking about here. Let's work with a real world example. Let's work with one we already looked at several months ago in another trading spotlight webinar here together with Admirals. And let's see, look once again at some key parameters here in the S&P 500. With our backtest result from back then and the input parameters we were looking at. So check out the YouTube webinar, YouTube webinar, respectively the channel from Admirals here. Scroll a little down to all the videos which are recorded and uploaded there in the YouTube channel, and you'll find the one here with the input parameters which are creating this equity curve. So we don't want to dig too deep into this matter now, but we want to really focus on the Monte Carlo simulations. In this case, you probably might wonder, okay, this is a screenshot. It's a funny story behind this, so a little anecdote. I did this here with a quant guy, let's say. It was a market opening webinar several years ago. In fact, that's one of the reasons why here July 2017 is displayed. So it's nearly 5 years ago, but I really like to use this chart here. Strategy still works. So this is the good thing about this. But I really like to tell this anecdote because it shows how you can really exchange ideas with others and use the input from them to probably also increase the overall visibility and make sense out of what you want to present to other people. So we had this webinar together, and he had an unstable internet connection back then. And so we already were in talks before what we want to present and so on and so forth. And I gave him my idea, and then he ran a back test here in Excel, and that's why you can see it here in Excel, the backtest results from strategy on the S&P 500. And still, when we ran the webinar, he had a unstable internet connection. The internet broke down, and it was probably 10 seconds before, I was taking a screenshot here for just making sure that I can continue with the webinar if he has problems to relog in here. And that's where this screenshot came from, and that's one I still use in this case, to give you an idea on why this looks a little different from the usual, let's call it a MetaTrader MT4, respectively MT5 expert advisor backtest here. And so let me just guide you here through the key parameters. You can see it here. There's the win rate. It's 47%. Let me just see one thing here. Yes, yeah. It wasn't Germany. It was a German internet issue. So yeah, we have some trouble here. So it's don't ask questions about Germany right now. So probably follow the news. I'm not sure what you get out of Germany, but please don't ask a question about Germany and the whole developments here, politics and all that stuff. Not a good one. So nothing positive to say here. Nothing to see. Let's move on with today's topic. So what's important for us? Monte Carlo simulations. Again, let's remember we need the hit rate, so the win rate, 47% here. And what we need is the so-called payoff ratio. In this case, you have the average profit and the average loss here. And then obviously you have to calculate the payoff ratio, which is 1.31 to 1. So if you divide 108 by 0.82 in this case, you get 1.3 to 1 in this case. So just that you know where these numbers come from. And these are the parameters, the only two numbers we need, in fact, to run here this Monte Carlo simulation. So when we do this, when we enter this hit rate now into the Monte Carlo simulator, and you say, I have a hit rate of 47%. So in, let's say, 100 cases on average, you have 47 ones and you have 53 zeros. And you have a payoff ratio. Each time a 1 hits, you get 1.3 euros, while every time a 0 hits, you lose 1 euro. If you put this now in a Monte Carlo simulator and you say, per each trade, let's assume you start out with 10,000 euros with your account and you risk 1% per trade. This is 100 euros. Then what you want to do is you want to simulate here in this case 1,000 trades and generate 15 different curves you get. And this is then what will be created in this case, in this simulator. So here's where the starting capital goes into 10,000, 1,000 trades you simulate. You have a winning hit rate of 47%. You have 15 different equity curves. You have 1.31 to 1 as a payoff ratio, and you have the risk per trade from 1%. Okay, so, and these are the key parameters you get then. So you have here Kelly. Some of you probably remember right position size in your trading. So this is given out of the fact that you have a formula you can use here, payoff ratio and hit rate, and calculate the mathematically correct position size to get the biggest bang for your buck, not looking at drawdowns. Then you have an average performance. This is, by the way, the white line you get here. You have the biggest max drawdown in this one simulation, by the way. So we'll do this now. I'm here at this with this example. I'll type in the same numbers in this Monte Carlo simulator I have open in the backend, and then run through this with you together. And you'll see that the numbers will differ. So that depends, as you can imagine, based on which series of ones and zeros you get. In this case, the biggest max DD was 26.7%. We had a min cap, so which means capital, the lowest point of our capital, which was at 7,987. So just imagine you start out with 10,000. You had to swallow a drawdown in your overall deposit size of 2,000 euros here max. We had to just swallow it. It was most likely here the lowest curve here in it's orange, something like that. Yeah, so probably orange. As you can see, by the way, it rose sharply. That was the first 150 to 200 trades. So if you're really trading with an edge, this is a perfect example of where you can see, okay, sometimes the start into your trading career with a strategy or it's probably not as favorable, probably given the fact that market conditions do not suit the strategy at all. Breakout strategy, low volatility market environment, for example. You have probably a very choppy market environment. So there was a breakout occurring, but the market pushes out of the range and then drops back into the range, however you put this. But still, if the market, let's say, stabilizes and turns into a favorable environment for the strategy, then the strategy can really outperform. And here you can see after 1,000 trades, it's an intraday strategy. So that means after 5 years, something like that. So that might be the first half of the year for 6, 7, 8 months or something like that, because it's an intraday trading strategy. You have 1 trade per day. That means 250 trading days. And if you break this down, then, well, obviously 250 days multiplied with 4, you have 4 years. So after 4 years, you're well ahead, even though the first 6, 7, 8 months or something, you had your head underwater. So this is just what happens. It's natural, and it happens more often. Certainly, what you want to see is that you see a rising equity curve right from the start, but still, that doesn't necessarily mean that you finish first. So as you can see here, the green one, for example, you can see that we topped out then after, what was something like 600 trades or so. You started to top out, and we finished 3rd or 4th, something like that. While here, this orange one, or it's not an orange one, it's a dark yellow one, you finish well ahead. However we put this, so let's come back here to this. You probably might wonder now, playing around with these numbers, really nice, but what can I draw out of this for my trading in general? So where's the value for me? Why is this of importance for me? Because it gives you something I refer to as mental stability. So first of all, you have to run this, you really have to have a trading strategy with an edge. You have to put in all the work and all the mental capital to find such an edge based on your personal needs. It's not just that you say, hey, Jens, please give me the input parameters, now I take them and trade the strategy myself. This won't cut it, because after such a period here, 6 months, 8 months, you probably will throw in the towel and say, well, the strategy doesn't work. It obviously does. So if you can stabilize these parameters, you can see that 15 equity curves are all in the green after 1,000 trades. But you might probably just don't build enough confidence. It's completely different. Let's put it that way. It's your business model. Let's put it that way. So it's your trading. It's your personality, which you can then find in the way you trade the markets. And this is completely different. If this is, let's call it your baby, if this is what you built, what you thought of, where you put in all the blood, sweat, and all the tears and everything, this is completely different. And you look at it from a complete different angle, and you know once the strategy works and once it doesn't, because you put in all the work. So this is why it's so important to put in all this work and then think about it yourself. And if you have the strategy, if all this is done, I'm not saying it's easy, but it's worth it, because if you have this, then the next point is you then can find ways to run these simulations and also build trust based on clear mathematical parameters. For example, you can see here as the max losing trades series. In this case, it's 13. I'm sorry, this is the winners. Here's the losers. It's 15. So what you can see is, for example, that it's completely normal after running here 15 different simulations. After 1,000 trades, there will be serious when you have 15 losing days a week. So 15 losing days in a row. That means nothing more. If you have here an intraday trading strategy, 1 trade per day, that's 5 days a week. This is 3 weeks. So from you start at the first, and the first week, all losing trades. Second week, all losing trades. Fourth week, third week, all losing trades, and then you have the first winner in the 4th week of trading. Most people will just not take this. They are not willing to take the pain connected with this. So I'm not saying that this is making things easier. So I myself sometimes find myself in a period where I say, well, is it not just worth it, but it's really necessary to have these series of losing trades? Well, from a mathematical standpoint, it is. And it happens, but it has no impact on the overall long-term profitability of the strategy. If the strategy works, if you continue to trade with an edge, then there will be, after here, this dark period, there will be light at the end of the tunnel, let's say, and things will turn around. And over time, you will overcome this natural drawdown, which happens. And this is giving you then the confidence and the mental stability to keep this up, in fact. But it's not just the mental stability aspect, it's also the risk aspect in this context. So, for example, if you look here at the average max drawdown, respectively the biggest max drawdown in this case, well, you can see it's 27%, but respectively 90% on average. What does this mean? Well, it means that if you start out, let's say, with 10,000 euros, that you have to be willing to say, okay, if I drop 30%, 3,000 euros, I need to be fine with this. So these are the parameters with the strategy. This varies, but all in all, even if this is the worst case scenario, and usually you're somehow seeing after 10 simulations, if you run this simulation 10 times and you only have the button here to push the green button, you can see this over and over and over again. So sometimes you probably see it's running around, let's say, 20% max DD here. But if it's only once above 20%, in this case 27%, then you probably have to say, okay, am I fine with such a drawdown? Can I withstand the mental pressure which this builds? If the answer is yes, great, then risk 1% per trade. If you say, no, I'm not really sure if I can stand this, respectively, if I'm honest with myself, I don't think I can do this. What can you do? Only one thing, because these parameters can't be influenced. Certainly, you can try to increase the overall hit rate of the strategy, increase the payoff ratio, the overall profitability. But all in all, the first way to somehow get this max DD here down is by reducing the risk per trade you're taking. So if you're not fine with this, try 0.7% risk per trade. So 10,000 euro, it's not 100 euro per trade you take, but 70 euros, for example, or 0.5%, whatever. And this will naturally bring down the max DD. Certainly, it will also affect the average performance here in this case, certainly, because you're now risking less, you're not making as much as you would with the initial, risk of 1%. But still, these are very practical ways how to see coin flipping having a positive impact on your trading, because the idea behind this is like flipping a coin with different payoff ratios in this case, or respectively different hit rates in this case. So now let's here look at the website. We have 5 minutes left, and let me run this through for you. So here, so this is the website. As you can see, for everyone now watching this on YouTube, respectively here in the live event, it's a German website again. So what we want to really use is only here the simulator itself. So you don't need to build it yourself. If you say, I don't feel comfortable with this, I don't like this, you can also build it via Excel. I haven't prepared anything now to show you how to build a Bernoulli distribution, a Monte Carlo simulation in Excel. Respectively, you can also program it in Python, for example. But this is probably then good for another a webinar on this topic. So starting capital here. So this is 10,000 euros. Number of trades you want to look at, 500. Well, let me put 1,000 in here. Well, by the way, 1 second. Just we said hit rate, Gewinnchance, hit rate, 47%. Then we have 15 different simulations, respectively graphs we generate here. We have a payoff ratio there from 1.3 to 1 in case of our S&P breakout strategy. And the only thing you do now is you click on simulate, start simulation, and take it from there. So now you can see here, still profitable overall. What's of interest here are these parameters. As you can see, 37.2%. So even here, if we come back to our presentation, it's at 26.7 in this case. So that was already very, very positive in this case. So only looking here at one simulation now and seeing a max DD of 37% means nothing more than you should be willing to lose 4,000 euros of your 10,000. If you don't like this, no problem. Let's reduce the risk. So let me just do this once again. So you see now 34, now you see 40%, even more than that. So you might wonder, why is this the case? First of all, it's just a basic strategy. In addition to that, it's a hit rate and a payoff ratio, which is giving you a small edge of, as you can see here, close to 8 cents per trade. What does this mean, expectancy? It means nothing more. So Erwartungswert is expected value. It means nothing more that for each euro you're risking, you're getting, in this case, 9 cents, for example. And so then we might say, well, isn't it sad that if you risk 1 euro, I should minimum gain 2 euros as a risk reward? Yes, that's true, but this is a completely different number. It's not risk reward, but it's the expectancy. So once this is positive, it means in the long run, you're making money on the strategy. So this is what gives us an idea on the overall profitability. Once this is negative, this just won't work. So let me just assume we have a hit rate of, let's say, 30% or so. You have a simulation here, everything is dropping. Certainly it does because on average, we're losing money here. In case of a positive number, the number means, okay, we are making money, so we have an edge. So this is something you have to look at first. Once this is negative, you will see that every equity curve is dropping, and you need to look into the strategy, the key parameters. If it works, obviously it doesn't, because else the expectancy would be positive. So you can see now, so we are here trading around 40%, 30%. Now we have 27, very optimal. So long thing short, you see, okay, 50%. Probably 45%. This is quite much in the basic version. How can I overcome this? Okay, let's work with 0.5 and run this again. You see, oh, great. Biggest max drawdown now below 20,000, 20%. And you can see it stays not anymore, but it stays now below, at least after several simulations, it stays significantly below 25%. You see, so we are not hitting, now we hit the first time 30%. Also this, the longer you play, or the more simulations you run, the more likely it is that even with a risk of 0.1%, you will rather sooner hit 50% on the upside. This is not looking into it. I mean, there will be bad runs that will just naturally happen, as you can see here. So it's overall positive, but still it could be that the environment is so unfavorable for the strategy that you're just running on the water. And this is then where the learning experience comes into play, and where Monte Carlo simulations can't really project this anymore, because this is like static. It's like it's not changing here the risk parameters. It's not changing the risk per trade you're taking. Let's assume you're on the right side of variance. You can see that the market conditions are in your favor. What will you do? Increase the position size, risk more, because now let's say you swing the bet hard or something like that. I don't know. It's like you risk more because you have an edge. This is like, okay, I can see it, I can feel it. The overall strategy, I feel comfortable trading it. So you risk more. That doesn't mean that you're kind of hazard or something like that. It just means that you're not risking 1%, but 1.5, 2% probably will naturally affect the overall profitability. And if you see the strategy doesn't work, well, you reduce the position size. That's the first sign. You also probably work with other take profit targets if you work with a take profit target, or probably you try to in this case try to intervene discretionary. For example, let winning trades run longer, work with adaptations in your take profit, in terms of working with different indicators, in terms of trailing stops, for example, and so on and so forth. So all this is not covered here. All this is not covered, but we are working only with the input parameters we receive, and then run here a back test, which gives us a clear idea, and then run different simulations and take it from there. Build confidence in what we're doing, knowing what we're doing, and then try to improve over time. And here still have enough confidence, given all these quantitative numbers, to stay with the strategy here and to fine-tune the strategy, in fact. So that brings us here to the summary for today. 1 second. Oh, sure. Yeah, sure. So there's a question from Darshan. If I can please pay 1.6 here, 1.6, and then what's with 3% risk? Okay. So what do you think what will happen? So it goes vertical. Yeah. So we're making lots of money in this case, still with a big drawdown. You can see it here. So this is where the risk component comes into play. So while you see here and say, well, this is great, no? So we really go vertical, and you can see here we are on our way to become the wealthiest person in the world. Still, you have to be willing to lose 74% of your capital first before you get there. So drawdowns in this area, well, I'm not saying that you shouldn't do this, but the thing is, you should be really careful when applying such aggressive way of trading, especially true when it comes to Kelly. And you probably should only trade small portion of your trading capital this way. This is how you could use this, certainly. And then if we now, let's assume here 57, yeah, what do you think will happen? So it will go even more straight up here. So now we are probably the richest person in the world, but still, you can also see that the biggest drawdown drops. In fact, while we are still risking 3%, you might wonder why don't we see a push up here too? That's really simple, because the chances of having a winning trade increased massively here to over 50%. So you will have losing trades, and you will lose certainly here over 30% over the long run, but still you have more winners than you have losers. And this is then seeing this sharp increase here, this vertical move on the upside. So, okay, let's come to the summary for today. So first of all, as a trader, we face a very important question, especially if we finally found our profitable trading strategy. What is the right position size in our traded strategy? And what the right position size has to make sure is that potential drawdowns are kept small. So this is usually the first way how we look at this, but still we also want to see an optimal growth of our capital, because all the pain we want to be paid for. And so in this case, the strategy in combination with the size or position size here corresponds with our personality, especially in terms of risk appetite. Some people are completely fine risking more. Some people say, well, I'm more the conservative kind of guy. What we learned today is that Monte Carlo simulations here deliver a great way to simulate different equity curves given certain input parameters, in fact, two, hit rate and the payoff ratio. And this helps us to get a better understanding of average winning and losing streaks, especially, so how long they last, potential drawdowns under different market conditions, and thus it naturally influences our risk per trade according to our personal risk appetite, gives us mental stability, more confidence in our trading. And this is where we close the cycle. It's how coin flipping really can have a positive impact on your overall trading. So for further information, check out the website from Admirals. If you have any questions around the offering from Admiral Markets, here are the contact details. as I mentioned already, fully regulated broker. So this is now where the last slide comes into play. I hope you enjoyed the webinar. Again, if you watch the recording on YouTube, please leave a thumb up here. Check out also here the subscribe button. Check it out. Respectively, click the subscribe button. Set a reminder for every webinar which will come after that. Follow us on Twitter, on Instagram, on Facebook, wherever. And that's it from my end. All the best. Happy trading. Talk to you next week with the next profitable trading strategy, by the way, on the DAX, just to mention that. And see you soon. All the best. Bye-bye.